how does this compare? I know there's been some I guess not new, but recently marketed policies. They call it like premium financing, where, instead of paying every single year, you pay a large sum, let's say $100,000, then you go to the bank, get a line of credit, and basically use the bank to pay the future years. How does this compare in terms of like cash value in 20, 30 years? What do you think of that strategy compared to something like this?
So premium finance is a very specific, also a very misunderstood concept and as a tool for financial planning. Premium finance could be a very powerful tool for the right scenario in financial planning. Premium finance could also be a very dangerous tool and is often misunderstood by the consumer, at points maybe even misrepresented by advisors. The concept behind premium finance is simply stated, it's the opposite of what we're talking about here. It's having a bank finance the premiums of the policy. And in our experience, the way that typically works best is when you have a high net worth individual that's expecting a liquidity event in a short time period of, let's say, less than 10 years, and their capital is better serviced in the asset that money is currently in, whether it be their business or whatnot. And it wouldn't make sense for them to put the resources towards an insurance policy, but again, they see the value of the long-term protection. So I would caution anybody who's buying a premium finance policy and then planning on utilizing the money inside the policy, it's counterintuitive. That's really not how those plans work.
Got it. Interesting. Why don't let me see. Hold on. I think we have a question. Hold on. Yeah, Justin, if you want, actually, hold on. If you want, just put it in the chat box and then I'll make sure Joe sees the question. While he's typing, we'll get into the next thing. One of the interesting things about these policies is banks will use these policies as collateral for line of credits. Do you usually recommend an individual who is going to be accessing that cash to do it directly through the policy, or set up a line of creded with the policy, with a line of credit with a local bank, and then access the funds that way?
So that's another question. Great question, Dennis. That's another question that is really specific to the client, what the client's looking to accomplish, and what the interest rate environment is. Okay. So I'll walk you through each of those scenarios. So if a client is very concerned about cash flow, okay, and can't use a monthly expense, it might not make sense to borrow from a third-party lender, because a third-party lender might have a monthly interest expense. Where a lot of mutual insurance companies, if you're borrowing directly from the insurance company, will take the interest in advance from the cash value. Now, there might be a higher cost associated with that interest, but it would also eliminate a monthly cash flow crunch that might be important to the clients. So that's not what's good or bad. It's what works better for the client. I would say the most sensitive element around that question is around interest rate sensitivity. Pre-2022, third-party lenders had variable rates against collateralized policies in the low to mid twos as a variable rate. When a lot of our clients have fixed rate loans on some of their policies, and those rates are as high as 5 or 6%. Now, how quickly the tide has turned, but 2 years ago, a variable rate would have been a much better option if we were purely looking at that from an interest expense comparison. Now, a lot of these mutual insurance companies have fixed loan rates of 5% as an option. If you have a 5 or 6% loan rate on your policy, that could right now wind up being a lot better than a variable rate. So there's two big things. Number one, cash flow. Are we paying interest in advance, or are we paying it monthly? And number two, what's the difference in the interest rate, and what does that sensitivity actually mean?
Got it. And one thing I know from the infinite bank concept, they usually recommend something like, if you have at least $10,000 a year to deploy. Is that the number you usually recommend as a minimum with your clients for a policy that really has a cash value focus? Or since you do it a little bit differently, you have different kind of recommendations?
So we never recommend to a client what a minimum amount that should go into these plans that makes it worth it. I will say that with our client base, we're very rarely writing life insurance policies For amounts less than that, they're usually substantially higher. And that's most likely because the clients that we're working with want to have high death benefits. They're a little older in age, and their premium contributions are going to be substantially more than $10,000 a year.
Okay. And is there a strategy that you could use for someone who wants to lock in these benefits, but maybe doesn't have $10,000 a year to allocate towards a policy like this?
Absolutely. And that goes back to the protection conversation. Irrespective of savings, we're big advocates of protection. And protection typically, Dennis, is better served when you're younger and healthier, right? So when we have clients that want to maximize their protection, but don't have the cash flow, which is very common, to be able to utilize that purely in a whole life insurance policy, there's different ways that you can structure, for example, term life insurance policies, which are purely for death benefit, but we can lock in insurability for periods of time and add things like conversion riders to those policies, whereby as a client begins to grow and as a client begins to develop and as a client begins to change his financial status, whether it be from cash flow or a liquidity event, we then can begin to convert some of those term policies without having to run the risk of insurability in the future.